The robo-advisor industry has been wildly successful since its inception back in 2008, with just the top 5 service providers accounting for over $360 billion in assets under management. It's no surprise that analysts are forecasting that the automated financial planning global industry to grow over $1 trillion by 2024. How do these services work, and are they worth it? Let's explore the pros and cons to see if robo-advisors are right for you. Why a robo-advisor? So you want to get into investing, but have no idea how to get started. It used to be that you were limited to doing your own research or hiring professionals, like a financial planner or stockbroker, to help you out. These days you have the option of having a robot to do all the work for you. Robo-advisors are exactly what they sound like. They advise you on what the best strategy is for investment based on a few inputs that you provide through a questionnaire, which may include age, investing goals, risk tolerance, income, and wealth. Pros: what are the benefits? Diversification. Powered by complex algorithms, robo-advisors create diversified portfolios to choose the best investments that fit your needs while spreading the risk. Exchange-traded funds, or ETFs, are usually the main investments since these are inherently diversified and tend to be on the less risky side, moreover than stocks, for example. However, depending on your risk tolerance, investments can be made in a variety of securities, which include stocks, bonds, mutual funds, and even cryptocurrencies. Number 2, automatic rebalancing. Most robo-advisors offer the ability to rebalance your portfolio automatically, which uses your asset allocation inputs as a guide. Let's say you want to have 75% of your portfolio in ETFs and 25% in stocks. If the stock market takes a turn for the worse and your portfolio drifts to 70% ETFs and 30% stocks, the robo-advisor will automatically correct your asset allocations by selling some stocks and buying some ETFs to get you back to your set allocation levels. Additionally, your asset allocation will likely have to adjust as you increase in age and wealth. As you get closer to the retirement age, usually you'll want to go for the more income-oriented and defensive route rather than the growth-oriented and aggressive route, which is more suitable as a younger investor. Based on your profile, the robo-advisor will automatically adjust your asset allocation levels so that you don't have to worry about this yourself. Number 3, tax loss harvesting. When investing on your own, and especially with a lot of assets that you're managing, it may become difficult to maximize your returns on investments when it comes to capital gains versus taxable income. Robo-advisors can help through its tax loss harvesting feature, where it intentionally incurs losses on securities by automatically selling them to offset any capital gains or taxable income. Researching and processing transactions happen almost immediately, so you can rest assured that this process happens efficiently and without human error. Some platforms provide guidance to using these gains as a gift or charitable donation to avoid paying taxes on their gains. Number 4, low barriers to entry. With the advent of the robo-advisor industry, competition has driven the barrier to entry down to a level where anyone can get started in investing with little to no money. It isn't difficult to find robo-advisor providers to offer low fees and zero minimum balances. This is a bargain considering human advisors can charge up typically to 2% of your portfolio's value every year. To put it into perspective, if you had a portfolio of $250,000, you could be shelling out $5,000 annually. Since the rates are much lower with robo-advisors, at up to around 0.5% of your total portfolio value, you would only pay $1,250, saving you $3,750 every year just in fees. Additionally, while human advisors may charge a commission every time the portfolio is rebalanced, you typically won't see this with robo-advisors. Cons: are there disadvantages? Missing human interpretation. While robo-advisors do their best to build a profile that best fits your needs, they're unable to capture everything. Sometimes it can be difficult to convey what you're thinking or feeling in a questionnaire. No matter how sophisticated a robo-advisor's algorithm may be, it usually can't decipher what you're trying to convey as it relates to any concerns or doubts that you have while investing. Number 2, emotionally unintelligent. Robo advisors are unable to connect to people and extract an understanding from their emotions. They can't explain to you why the stock market tanked or provide insight on past market performances. You may have money-related issues or concerns that you may want to talk through, and only human advisors can help with that. Number 3, customer service with less experience. Companies that offer robo-advisor services oftentimes have robo-customer services as well. This means that you will likely get canned responses from automated response systems, or at best have someone on the other line that has little to no experience in investing. When you work with a human professional, you get a personal interaction from an experienced professional with decades of experience. It can be reassuring to deal with a human than an emotionless robo-advisor. Is this right for me? It's clear that there's a huge demand for robo-advisors all over the globe, but it isn't for everyone. Sure, it can process transactions and automatically manage your portfolio seamlessly and efficiently, but does it provide empathy or understanding when you're looking for it? Your financial planning will ultimately be defined by what you're comfortable with. In this day and age, high net worth investors would rather put their trust in advisors who they've formed trust with over the decades of working together. But for new investors with low net worth, robo-advisors can be a great way to get started with investing. I hope you enjoyed the video. Subscribe to our channel and press the bell icon so you don't miss our future content. Anyways, that's it for now. Stay smart and think long term.